And if I had to bet Bitcoin versus gold over the next 2 to 3 years, I would bet Bitcoin. Doesn't mean it's 100% likely to outperform. And I like to own both, and I have owned both, and I still own both. But if I had to say, okay, gun to my head, if I had to say which one I think outperforms, I would say Bitcoin, because I think that gold is somewhat euphoric at the moment. I wouldn't say it's a bubble, but it's somewhat euphoric, and I think that sentiment on Bitcoin is somewhat unfairly negative. I think that we're not going to see one of those 85 or 90% drawdowns is my base case. I think we're closer to the bottom than the top. I think most of the pain's behind us. Not to say that the bottom is certainly in, but I think the worst part of the sell-off is behind us. We probably have a grind to go through until we're kind of back in a true bull market. And I think that, the most of the pain was in the levered entities.
In periods of monetary transition, correlations shift, narratives fracture, and investors are forced to reassess foundational assumptions. One of the most persistent misconceptions in macro investing is that gold and Bitcoin are inherently opposed assets, that one must rise at the expense of the other. Lyn Alden dismantles that simplification. Gold and Bitcoin can rise together. They can fall together. Before we go on, please take a moment to like this video, subscribe to the channel, and turn on post notifications for more content like this. Every action helps with the YouTube algorithm and greatly supports the channel's growth. Thanks for your support and enjoy the video.
Gold and Bitcoin can go up together. They can go down together. They both sold off in March 2020 when we had a liquidity crisis. On average, gold is more risk off. It's an established, large, liquid asset that's not changing anytime soon. It can be held without counterparty risk. Bitcoin is a 17-year-old asset. It's volatile. Until recently, institutions could barely own it. Now they around the margins, they dabble in it. It's still widely held by individuals, many of which are just not known who they are. There's questions around quantum, right? So it's perceived as a more risk-on asset. And then some governments are still opposed to it, so they don't like privacy, or they don't like really big gains, so they say, okay, we're going to do unrealized capital gain taxes on it, or we're going to imprison developers that make privacy functionality that can be used with it. There still are these kind of technical, regulatory volatility uncertainties around it. So on average, risk-off conditions will favor gold, and risk-on conditions, I think, will favor Bitcoin. We've seen AI has added a wrench to risk-on markets. So the really big mega caps that have been kind of the foundation of the U.S. stock market bull run, they used to be very capex light. They'd make a ton of money. They had network effects on their products. They'd plow their money into buybacks, which is really good for the share price. And now they're plowing it all into AI capex. So their free cash flow in many cases have gone sideways to down, or in Oracle's case, dried up entirely. And that kind of makes investors spooked around their share prices. Then they sell off the software companies, which have also been kind of a leading contributor to the bull market. So you have these more risk-off conditions, which I think has favored precious metals. But I do think once the dust settles here, and we have another risk-on cycle, I think Bitcoin will be a beneficiary of it. Just because something becomes extreme doesn't mean it's wrong. For example, when Nvidia just soared a few years ago, it became overbought on pretty much any RSI metric you're looking at, but it stayed elevated because the fundamental reasons were real, that the whole world suddenly wants 10x or more GPUs than it wanted before. And I think the same is true for these RAM stocks. A lot of them have just hit obscene levels of technical overbought status, but I think they're reflecting a pretty persistent shift in our demand for RAM on a persistent basis. And I think the way I've described the precious metals bull run is that while I have been concerned around the sheer speed that they've moved, and therefore their overbought status, I used to be bullish on them in the sense that I viewed the downside as very low. Many of them, especially silver and platinum, but also to some extent gold, were pretty close to their mining costs. They were very underowned, and yet I viewed them as having a lot of upside potential. Now that they've had this big move, they're less asymmetric in the sense that I would not be surprised to see precious metals fall 50%, but I would not be surprised to see them grind higher either. They're just the overall asymmetry is not there anymore. And I think that it's not that they become a bubble or overvalued. I think that gold, silver, and platinum were undervalued. I think that they were underowned, undervalued compared to the advantages that they have. And the market kind of quickly right-sized them. So I think they went from undervalued to somewhere in the ballpark of fairly valued pretty quickly. So I view it as a locally overbought period, but that is pretty much backed by fundamentals. Like it makes sense for them to be at roughly these levels. As far as Bitcoin's concerned, I do think it's oversold. I think it's been kind of artificially lumped in with the software stocks more than it should have been, like we talked about before. So it's correlating with them oddly closely for no particular reason. I think the washout from the Treasury MNAVs, the Treasury Company MNAVs, was painful. I think that had to be kind of worked through. The quantum FUD had to be explored to some degree. I think that makes sense. The 4-year cycle had to be tested, kind of self-fulfilling prophecy. But I think, like I said before, I think the majority of the pain's behind us. And if I had to bet Bitcoin versus gold over the next 2 to 3 years, I would bet Bitcoin. Doesn't mean it's 100% likely to outperform. And I like to own both, and I have owned both, and I still own both. But, if I had to say, okay, gun to my head, if I had to say which one I think outperforms, I would say Bitcoin, because I think that gold is somewhat euphoric at the moment. I wouldn't say it's a bubble, but it's somewhat euphoric. And I think that sentiment on Bitcoin is somewhat unfairly negative. I think over time, in this more multipolar world, neutral reserve assets become more important. And this is something I'm talking about for years. And we've seen a huge run up in gold and silver and platinum. And I think if Bitcoin gets big enough, it can become one of those neutral reserve assets that sovereigns want to own. I think, because of network effects and things I talked about before, and just kind of the path to dependence of these things, they turn to what they already have. They turn to what's worked for centuries and millennia. They turn to what's big and liquid, gold. Tens of trillions of estimated gold market capitalization out there. So I think that's the incumbent kind of default winner in a more multipolar world. And then if Bitcoin becomes big enough and liquid enough and perceived as being stable enough, and some of these questions get answered around quantum and stuff like that, that's where it could also be a neutral reserve asset. So I think that instead of the US dollar and the US Treasury being at the center of everything, I think that in a more multipolar world, you have neutral reserve assets like gold kind of being at the center of everything. And then you have major currencies like the dollar and Chinese yuan being regional trade major currencies.
Alden challenges one of Bitcoin's most persistent narratives, the mechanical 4-year halving cycle. In earlier cycles, the halving dramatically reduced new supply issuance relative to existing circulating supply. That supply shock materially influenced price dynamics. Today, Bitcoin's annual supply inflation rate is well under 1%. The marginal reduction in new issuance from halvings is far less impactful than the behavioral patterns of long-term holders selling.
The overall network, obviously, Bitcoin is mostly immutable. It changes very, very slowly. It continues to function well as it always has. The part I would kind of, touch base on is the paper market is not the only issue. I've kind of made this point a couple times. I think the biggest issue is there hasn't been a lot of top-line demand this cycle. And that includes on-chain, buy a hardware wallet, stack Bitcoin type of demand. So completely non-paper demand. If that had come in, the price would be higher. So I think the fact that was on the weaker side this cycle left most of the demand in the corporate sphere, right? So most people buying either the ETFs in their brokerage account or buying the treasury companies in their brokerage account, or in some cases institutions, buying their other products. And that's been by far the majority of the demand for Bitcoin this cycle. And so that lack of kind of broad retail demand, I think is the single biggest factor. And then we can add other things on top of that. There's a little bit of fear about quantum, which I think is overblown, but it is I think affecting price to some degree. Just the overall kind of paperization of Bitcoin is an inevitable thing that it has to go through. So I think there are multiple factors, but I actually think the number one thing is just kind of lack of top line demand, either in paper or direct form. Now we have seen a decent amount of buying, but it's been offset by a similar amount of selling. from longer-term holders. And that so far happens every cycle. So every kind of major bull market, you see the percentage of coins that have been held for, say, 1 year or more go down. You see some kind of profit taking. And the general trend there is not that those people have, say, lost interest in Bitcoin, is that they've been holding for many years. And they might have put, say, 5% of their net worth in Bitcoin, and it's up over 10x, in some cases many times more than that, depending on how long ago they bought. It could be over 90% of their net worth at some point. Many of them, they want to upgrade their consumption levels. Maybe they started a family, maybe they just, they want to consume more. And so you generally see selling from some of those older holders, and new buyers come in. Either directly or through these proxies, these treasury companies, these ETFs and things like that. And while we did hit new all-time highs this cycle, and I think we'll have higher lows wherever we hit as well. So there has been more demand than selling, but there's not been a tremendous amount of new demand compared to selling, which is why we only kind of we hit moderate new highs. Nothing particularly tremendous, not even a double compared to the prior high for the cycle. And so it's not that there's no top line demand, and it's not that the institutions don't move it. I mean, they have a tremendous amount of capital that they can move it with, but it's been kind of mediocre this cycle, and it's been offset by the holders selling. I think quantitatively, the 4-year cycle is no longer relevant in the causal sense. Meaning that the amount of new supply that is affected by the halving, for example, that's kind of the key catalyst for the historical 4-year cycle. That used to matter in the first 3 or so cycles. That was a tremendous difference in the number of new coins hitting the market. Now that most of the coins have been mined, the annual kind of supply inflation rate for Bitcoin is well under 1%. It's a much bigger factor, the percentage of older coins being sold, than the halving. So I think that from a fundamental standpoint, the halving in the 4-year cycle is no longer relevant. But I do think that there's still a self-fulfilling prophecy around it, which is to say that many people still believe they're conditioned to the 4-year cycle. So I do think that there was some reflexive selling in Q4 of last year, because people had the view that, well, I mean, if it was going to hit its peak, it's going to do it this quarter, and might as well get out and buy lower. So I do think that there's still some remnant of the cycle, even though there's no fundamental reason to expect it to behave like that. There's many other variables that can move it around going forward, is how I view it. And I think liquidity plays a big role. I think bubbles popping plays a big role. So, for example, in the summer of 2025, some of those MNAVs on treasury companies just got really out of hand. I mean, Strategy, less extreme because it's bigger, but I mean, it was over 3 times MNAV at its peak. Metaplanet, got over as late as June of 2025 was at like 8 times MNAV. In some of their earlier parts, they were higher, but even when they were pretty big, they got to an 8 times MNAV at one point. Many of the others were just euphoric. And I expected that to come down, but it came down actually faster than I would have guessed. I mean, I would not have guessed we'd go from, say, 8 times MNAV on Metaplanet to 1 in a handful of months, but we did. Markets tend to move quickly when they move. So I think that we've kind of had to burn off that bubble. I don't expect us to have as big of a drawdown as last time. I think that some of the drawdown will be in those treasury companies. It already has been. I mean, some of them are literally down 99%. Other ones are down, kind of what you normally see in a Bitcoin bear market, because I think that's where the euphoria was. I think there was not a lot of euphoria in baseline unlevered Bitcoin. And so I think that while it's obviously been a pretty severe market downturn, like something like 50% at this point, a little over at kind of the intraday lows, I think that we're not going to see one of those 85 or 90% drawdowns is my base case. I think we're closer to the bottom than the top. I think most of the pain's behind us. Not to say that the bottom is certainly in, but I think the worst part of the sell-off is behind us. We probably have a grind to go through until we're kind of back in a true bull market. And I think that, the most of the pain was in the levered entities.
The core message from Lyn Alden is not about short-term price targets. It is about structural evolution. Gold has transitioned from undervalued and underowned to approximately fairly valued. Bitcoin has endured misclassification, institutional concentration, and leveraged excess, but retains asymmetric upside within a multipolar reserve framework.